Okay, so again, welcome. This is the PIP movement range presentation we do here at FX Street on Thursdays. And we follow this up same time tomorrow with a look at the current market on Fridays, again for another half an hour. And what my hope is that on Thursdays today, we discuss trade management, and on Fridays we discuss trade entries. And again, my reasoning for that is I find too often the presentations, myself and anybody else, we focus so much on entries that the trade management and the current temperament of the market is sometimes just kind of lost in terms of how we're dealing with the current market's mood. Okay, and that's really what I'm talking about here. Once you get into a trade, how do you gauge what the market's going to be capable of doing, and how do you manage that? Because that is absolutely what is going to affect your profit target and your stop loss. Okay? So what I'm going to do here is I'm going to go through a few charts because we use the live charts here. If there are any particular time frames and pairs that you want to look at, please let me know. I normally focus on 15-minute, 30, 60, 4-hour, and daily charts. That's my world. If you have another request, I'm open to it, but just got to give you an idea of the time frames that I scan. And we'll go ahead and start looking at these pairs through a number of time frames. When we find an entry or a position at which we want to go ahead and get a better look at what the current market's mood is in terms of volatility, we'll go ahead and jump over to the PIP movement range study. So let's go ahead and get started. I just want to give you an outline of how we tackle each one of these Thursday webinars. I'm going to start with the Euro-US dollar for no other reason than if I were sitting at home, going through my, in my home office, going through the charts, I just kind of go through the dollar correlated majors first. And by that I mean I'm looking at pairs that most consistently either inverse or sympathetically move with the U.S. dollar index. Now, we usually take a look at the U.S. dollar index on Friday, so I'll hold off on that. But for any of you out there that are not focusing on pairs like commodity futures like the U.S. dollar, crude oil, the continuous commodity index, as well as, those are three biggies. I mean, you can throw gold in there, but I don't throw gold in there as often as I used to. Most definitely the Dow Jones, or a look at what's going on in equities. Those are 5 key futures contracts that we'll look at tomorrow. But when I say dollar correlated, I'm talking about pairs that move either sympathetically or inverse with the dollar. The Euro-US dollar is one that moves inverse. So if I know I've got equity strength, in today's environment, I'm usually looking at a weak dollar index, and that means I'm looking at a stronger Euro-US dollar. Now today, take a look. It's a 15-minute chart. You look at the weakness here. That's telling me what? Even before I look at the market, let's say I'm a hermit in a cave and I don't know what's going on other than this 15-minute chart of the Euro-US dollar. I can pretty much have a pretty good idea that the dollar is up because these two markets move inverse to one another. The dollar is up on a 15-minute time frame. Let's not forget the time frame and how that reflects on the psychology. So there's the short-term intraday time frame. And I'm pretty much guaranteed that my Dow is probably pulling back, which, let's snap back to what's happening right now. Yesterday with the Dow breaking 10,000, closing above that level, I think there's a lot of traders and investors out there who are waiting for the head fake. Where's the shoe going to drop? Does the market really want to stay up here? We're probably due for a little bit of a test of that. So the correction we're seeing now, a little bit of dollar strength, probably a little bit of Dow weakness, and you can glean all that from this view of the short-term intraday chart for 15-minute Euro-US dollar. Again, I stress that it's a short-term intraday look. A 15-minute chart is like a 5-year-old, okay? The moods will swing, okay? So just keep that in mind. So what can I tell from this 15-minute chart? Currently, the cycle of the market is down, so I'll be looking for swing shorts on this time frame. Okay? And if I wanted to get an idea of, you can see some of the volatility we had back here with these wicks and the range of the candle. If I want to get a current look at the mood of this particular pair and of this particular time frame, what I can do is I can head over to the PowerStats point, and let me go ahead and recapture the window here so you guys can see what I'm looking at. Okay, you should see an internet browser now. Okay, so what we're going to do is we're going to go ahead and take a look at the movement per hour of day. Okay, and we'll zoom into specifically the Euro-US dollar. And again, what am I trying to do? I'm trying to get an idea of what the current personality of this market is, what type of volatility I'm likely to see, and then we'll zoom into looking at potential support and resistance. So I know I've got a 15-minute chart that could be giving me a swing trade. So here are the questions that I want answered. What's the likelihood of getting a correction to possibly let's see, I'm looking at maybe, just trying to get an idea of where that bottom line of the wave is right now. So about 49.03, that area. So what's the likelihood of me seeing about 4,900, 48.95 on a correction so I can enter short? Well, the first thing I want to look at really is two things. One, if you're not already starting your day with some sort of look at the economic calendar, please include that into your morning habit, because that's going to, again, give you insight into market psychology. So we're going to go ahead and take a look at that right now. Okay. Okay, sorry about that, gang. Okay, so what I hope you're doing each and every day is starting off with a look at the economic calendar, because that's going to dictate what type of volatility you could see as data enters the market. All right? So as you can tell, we're coming off a recent U.S. set of hot zones in terms of consumer price index, CPI numbers, all right, jobless claims and so forth. Now, that's already happened, so it's already been factored into the market in terms of the reaction. But I hope that you are taking a look at that each day, because if you're not, the timing of the volatility, the tolerance you're going to have for your stop loss and the expectations you can have for profit targets, those are all going to be affected by data. I'm not saying that you should trade the data. For example, I'm not saying that you should be looking to trade the initial jobless claims expected versus the consensus versus the actual. That's not what I'm saying at all. But what I am saying is that 8:30 a.m. initial jobless claims, 12:30 Greenwich Mean Time, is going to inject a certain amount of volatility into the market, and you have two choices. You could either go ahead and gauge what the typical reaction is of the Euro-US dollar between 8 and 9 o'clock and get an idea that you could be looking at as much as, on average, 55 pips to, on the high side, to as low as about 20 pips to the low side, and about 35, 40 pips in between. Okay? So keep that in mind. This is one look at volatility. Now, this is a 1-month sample. So again, what I'm trying to determine is, what is the typical personality of this pair at this time? Now, knowing that there was an 8:30 release, what do I know about the likelihood of my reaching the high end of the volatility? It's better, I have a better chance of reaching that. Is everybody with me? So what I've done here is I know between 8 and 9 o'clock, I could have a very quiet day of about 20, 25 pips. I could have a more volatile day of about 55 pips, and on average I can see somewhere between 35 and 40. Where I'm going to be along this bar is going to be greatly affected by the economic releases that we see. Now, you guys know that. I mean, I'm sure you guys understand that how data can impact volatility, but we're taking that next step, and we're actually trying to identify, in terms of pip movement, what that volatility could be. So if I'm expecting a correction, if I want a correction, and I didn't get it for 8:30 and that economic hot zone there, when could I expect to maybe see the next opportunity? Probably not until later on this afternoon, and that's not going to work for me, because I don't want to be entering trades in the afternoon, the doldrums of the New York session. And not to mention, the potential impact is not nearly as high as the CPI numbers or the jobless claims. You can see here by the expected impact. All right? So that's very important to keep in mind. Okay, so let us zoom in. Now, again, does anyone have any questions so far? Does anyone have any questions as far as what I'm trying to get across in terms of not just giving you general broad strokes of, hey, economics means high volatility, economic releases, but let's define those releases and see how they work to either factor into our entries or our risk management and trade management. Everyone with me so far? Okay, all right. I just want to make sure when you guys are quiet, I want to make sure I haven't either one put you to sleep or two lost you. So I just want to make sure we're all on the same page. All right, let's zoom in now. So we have an idea of expected volatility. By the way, we're now trading within the 9 to 10 o'clock hour, as you can see here. Okay? So my volatility expectations go up. My low of 25 pips to about 65 pips now is the expected range. I don't have any economic releases that are liable to give me the high end of this, right? I don't have any economic schedule releases that are likely to put me in that 60-65 range. So I'm going to assume we're going to come in around 40-45, which is the average for the 9 to 10 o'clock hour. Again, this is Eastern Standard Time, this graph here, all right? So let's zoom in to see what 9 to 10 o'clock could actually bring us. So I'm going to go to the Stop Loss Take Profit Advisor. And again, I was looking at a 15-minute time frame, right? So between 9 and 9:15, the expected price range, based upon the volatility that I'm seeing, based upon on the price movement that we are seeing, I can see that the range expectation is a low of 48.42 up to a potential high of 48.82. Now this will adjust in about 2 minutes when I get my expected price range for 9:15 to 9:30. But for now, I can see, as I was watching this chart between 9 and 9:15, it was not very likely that I'm going to see that trigger that I want on that 15-minute Euro-US dollar. Let's go back there for a moment, because I don't want to get so far away from the current chart that we forget the point of all this examination. So again, I'm looking, here's the 15-minute Euro-US dollar. You should have that chart in front of you again. My entry is the bottom line of the wave, which is the 34 EMA on the low. Okay? That price is 49.03. So I would like to get short at the 34 EMA low, but since it's right there at the psychological level, I don't mind doing what I call stepping in front of size, because there's going to be a lot of order entry waiting at the 00, 4,900. So I don't mind doing what I call stepping out in front of size and shorting at, say, 48.95, okay, which would put my short right about there, okay? And I can actually go ahead and put it right on 48.95 as far as that line goes. Let's do that right now. Okay, so there's my 48.95. That's where I can step out in front of the 00. That's fine. What is the likelihood now between 9:15 and 9:30 that I will see this 48.95 to short? Now, we've already considered the data ramifications, okay? We've already considered the ramifications for what we're dealing with between economic data release-wise. We've already dealt with the 8:30 volatility, all right? So now I want to examine what's the chance of my getting to 48.95. So let's go back over to that PowerStats, and I'm going to refresh this page. So I'm looking at 9:15 to 9:30. Now, since we have been correcting steadily higher, in the next 15 minutes, do I have a pretty good chance of reaching my 48.95? According to the price range. Now, remember, these two numbers, 4,900 and 48.64 on this 15-minute look, right here, this first column, if you will, or first bar. That is not saying that we're going to go down to 48.64 and go up to 4,900. What this is saying is the price range that we could see, that's likely to be the ceiling, this is likely to be the floor. So I'm basically very likely to move within this 36 pip range. Now 36 pips on a 15-minute chart, that's a good number of pips, considering that between 9 and 10 o'clock on average, I'm likely to see on average, 40, 45 pips. So I realized that just by looking at the expected price range and comparing it to the PowerStats 1 month look back, this market's still fairly volatile. Now, a lot of that's affected because of the volatility we saw at 8:30, but this market is really factoring in a large amount of volatility. I think 36 pips as a potential price range is a little high, but I see that I do have the possibility of getting up to 4,900, which is going to suit me just fine because all I need is 48.95 to trigger my short. Okay? And I can see also, once that short is triggered, the expectations I'm going to have for movement in terms of my tolerance for volatility has to still be pretty high between 9 and 10 a.m. and again between 10 and 11 a.m. because we are dealing with the three most volatile hours of the day in terms of price movement for the euro-US dollar as London overlaps with New York. Okay? And the closer we get to noon, you can see the price movement and the volatility begins to contract. Quick question here, why is 2,300 so volatile? You'll notice on a 6-month look back, it is the most volatile, this is on average of 6 months versus the 1 month look we were just looking at. On average, it's probably the most volatile hour of the Asian session, and it has to do with economic releases. And I have to mention that 1 or 2 very volatile economic releases during this hour can absolutely skew my sample. But on average, that 11 o'clock bar is going to be likely one that sees different economic releases or different, geopolitical events. On average, I noticed that if you take a look at the dollar yen here real quick, let me show you here, since we are talking about the Asian session, you'll see the dollar yen gets pretty volatile too. It has to do with economic releases that come out of Asia. That's exactly where that's coming from. If you're looking at that craziness of 2,300. But just keep in mind, while it might be a very wide-ranging candle, notice that don't get caught up in the size of the bar necessarily. That does tell us there's been volatility, but take more note of the average, which is the band across it. The volatility goes down. I mean, this is ridiculous. I don't even know that we've ever had an hour between 23 and 2,400 on, typically that's less than 5 pips. Because notice the low here shows less than 5 pips for that hour. That's very unlikely. So you can see, as far as the range goes, that's a very unlikely scenario down here at this range. Okay? And you can see up here, the euro-US dollar is capable of moving 50 pips in an hour. It just isn't something that's very likely. Again, the average is going to be more along the lines of what we would have seen the preceding 4 hours, somewhere in that 25, say 20 to 30 pip range. Okay? So the bar sometimes makes it look like it's a more dramatic story than it really is. When you take a look at the average, when you take a look at the actual high to low pip range, the volatility is there for sure. Okay? That's what you need to keep in mind. But on average, you're probably going to see the same type of price action you would see in the preceding 4 hours. Everyone clear with that? Everyone follow me? Okay. So, again, what we're doing is looking at each hour of the day, and then we're looking, as a broad stroke, and then we're looking to zoom in to what we're likely to see in terms of actual support and resistance. And notice that if you go to larger time frames, okay, you're going to see a wider price range on these expected price range bars, because just given the common sense of time, I'm much more capable of moving in a wider pip range if I'm given more time. I always like to liken it, like to give an example of if you and I, we're all going for a walk, we're going to cover more ground in 4 hours than we would in 15 minutes. And that's the same logic that goes behind why, if you were trading a 240-minute chart, you need to have a much more your expectations for profit targets and your expectations for stop losses need to be in a wider range. You know, one of the biggest mistakes I see traders do is they treat their risk management on a 15-minute chart the same way they would on a 240. The psychology is very different. Okay? And I'm not just saying that anecdotally. I'm giving you statistical evidence here. How far a price chart can move in a 15-minute bar is very different than on a 240-minute bar. And if you're looking at 240-minute price patterns, or if you're looking at 240-minute candles, again, you're going to have to be much more willing to let the market move around than if you were looking at a 15. Okay, so let's take a look at the price chart again. So this is that 15-minute chart. Let's go to a 240-minute chart. And by the way, let me just kind of in interest of just let you guys see what I'm looking at as far as indicators go. I've got the 34-period moving averages on here. You know, my wave, the 34-period exponential on the high-low close. Okay. The grab candles are a freebie download you could get from my blog over at RagheeHorner.com, and what they do is they plot the 3 lines automatically, and if you notice, I've got this color coding on my candles, and the color coding gives me an idea of where I am in relation to the wave. So if I start seeing a lot of green candles successively, that tells me that I'm likely shifting into a markup cycle. Okay, if I see a lot of red candles, I'm in a markdown cycle, and if I see a lot of blue candles, I'm in more of a sideways, a range-bound cycle. So it's all keyed off the 34-period high-low close on the exponential. Now, differentiating up and down candles is basically done by the light green and the dark green. So if the light green is up candle, the dark green is then a down candle. So that's how I differentiate between up and down candles, and this is how I gauge the strength of the market and where I am in relation to the wave. And that's what I call grab, which is just kind of my short for green, red, and blue. Green, red, and blue. So that's what it does to candles. I also have running the Autochartist chart pattern automation. And if you notice here, let me show you, what we've got is, I know the colors are a little hard to see in terms of the emerging patterns, okay, but you'll see that the chart patterns are listed here in the upper left-hand corner. It's a plugin that actually plots the chart patterns automatically on your MT4, okay? So in terms of what I'm looking at for a complete pattern, you'll notice the last complete pattern was this channel up, which has happened some time ago. They give you the time and everything. And then my emerging pattern, the pattern that was emerging was this right here, this triangle, which already broke to the upside, as you can see here. Okay? Now, in terms of what I want to do now with this 4-hour chart, I'd be actually looking at a potential swing trade off the 34 EMA high, which is right here. And we actually triggered that, I believe. The low of this candle was 48.42. Now, by the way, just as I had stepped out or talked about stepping out in front of size on the 15-minute chart, with that double zero, the same thing applies, for example, to this 240-minute swing. Now notice, these two time frames have two very different personalities. I'm actually looking at a swing short here, okay, or I'm looking at a swing buy here. And again, this is one of the reasons I always talk about you have to treat each time frame as a standalone. You have to treat each time frame almost as if it was a completely different symbol, because in many ways that's the way it behaves. All right? A 4-hour psychology is very different than a 15-minute psychology. All right? So I'd be looking for a correction here. Now, if I was willing to step out in front of the double zero, the other thing you can consider in terms of psychological numbers is there's a psychological number at the 50 pip. I can absolutely step out in front of size at the 50 pip. So I'd be looking at 48.50, and I'm basically stepping out by about 6-8 pips, which on a 40-minute chart is not that much, is not that big a deal. Okay, let's get back down to that 50 pip. All right, so it already happened. So this happened, during the volatility of those economic releases, but this would be a swing trade. Okay, this would be a swing trade. All right, got a couple questions here. That 5.5 pips was September 22nd during the G20. Okay, again, it's not, and what I was trying to get across is it's not a typical scenario. It's on a day-to-day realistic scenario for my 2,300 hours Eastern Standard Time, 11 p.m., to be that low in terms of volatility. And so thank you, Rojo, for showing us why and when. It's not that it's not capable of doing it, it's just not very likely on a regular basis, for sure. In terms of, again, let me go back here. Now, which symbol were you talking about? The dollar yen or the euro US dollar? You can see here there's no 1-hour candle at 2,300 with a range 130 pips. Which pair? And while you're typing that in, got another question here. Given that the higher time chart will require bigger stop loss levels, how can a newbie who has a full-time job but small, I would love to say there's an easy solution, but when you have certain things that are going to limit your trading ability, your time to get to the market, the type of stop losses that you're going to have to utilize. Number one, the first thing is, if you're trading part-time with small capital, the first thing you're going to have to do if you're trading a large time frame, if you choose to, is go with smaller position sizing. I mean, that's a given. Okay? That's the first thing you're going to have to do. You're going to have to go with a smaller position size to make that potential loss, if you do see it, affordable. Okay, so a 15-minute chart, you might be able to take a larger position size because the risk and the reward are smaller. On a 240, you'll have to adjust that with your position size, which is doable. It's just going to have to be the reality until you are able to build up your account. Part-time trading with large time frames is great. It's fine, because if you're not in front of the computer, you can't deal with a micromanaged type time frame like a 15 or 30. So 240s and dailies are fine, but you're going to have to go with a smaller position size. That's typically how it works. As far as this indicator, no, it is not a free indicator. It's not a free indicator. There are plenty of free indicators you can get at the MT4 database, but no, this is not a free indicator. You can get this from Autochartist if you're interested in automating your chart patterns on your MT4. You can also get, right here at FX Street, you can actually get some Autochartist sample, chart pattern alerts. FX Street Premium members get access to the Autochartist software, which is different. I'll probably talk a little bit about that tomorrow. And again, chart patterns, let me just mention, you don't have to be a slave to any kind of software. I love this software because it takes a lot of the analysis homework off my table so I can focus on other aspects of trading. But, obviously chart patterns are something you can do discretionary, but I know for myself that there's no way that I can jump from a 4-hour chart to a 1-hour chart and necessarily do the analysis on the chart as quickly as the Autochartist could for me. That's something to think about. Okay, so I got my answer here, Euro US dollar. So if you go back let's go back to the PowerStats here. And I don't have access to what the market's done over the last, on the charting view that I've got right now, as far as what the market has done at 11 o'clock. There's no 1 hour candle at 2300 with a range more than 30 pips last month. So what we're looking at here is the average of about 25 to 30. I don't know what this high range of 50 was. Again, this could have, I'd have to take a look. I don't have that in front of me. Oops, let me turn the camera back on. Sorry about that. I don't have that in front of me. I'll take your word for it. But on average, I know I'm going to see 30. Where this 50 came from, I'll have to take a look. I don't know. Again, anytime I see a candle that has this kind of range, again, it's pretty unusual to me. As you mentioned, this might have been September 22nd, I believe you said the date was, with that 5.5 pip. But I don't know when we had a range of under 5 pips, as you can see here. So I can probably let you know how that was calculated, or why that was calculated, in terms of this PowerStats breakdown. And like I said, the average falls in line with what you've told me, this 30 area. So if you go to 6 months, it's still going to be affected, though, by that odd range. So that's something to think about. The high wasn't as high. The low is just as low, and my average is somewhere between 20 and 25 versus 30 and 35. Okay, let's see. I'll take this last question, and we'll wrap it up here. As every time frame has a different personality, do I consider the longer-term trend? I will consider a longer-term trend only if I'm looking for a filter. I think the longer-term trend is a filter at best. I don't mind trading a 15-minute chart short if as opposed to what the longer-term time frame might be. Let's go back over to the price charts here. I don't mind going against, say, a daily chart. I don't use multiple time frame confirmation. I don't think it's necessarily. I don't know that it's justified. Okay, to be quite frank, I don't know that it's always justified, because if I want to say to myself, okay, if the daily chart, or again, what's the time frame we're using as the overall psychology? To me, the daily is the strongest psychology. Okay, so if I have an uptrend on the daily chart and I want to use it as a filter to say I only want to take buys on my intraday time frames, that's fine. It's a filter, and that's certainly fine. I don't do that because I know the distance between in between the highs and lows of every single day. For example, today's daily range is a high of 49.66 to a low of 48.42. So it's about 140 pips, right? 150 pips or so. So I know that at 150 pips, I could have uptrends, downtrends, all sorts of market cycle shifts on a 15-minute chart. So while I might choose to only take the buys if I'm using the daily chart as a filter, I don't do that. I literally treat each time frame as a standalone. Now, if I'm trading a 240-minute chart and the daily chart, I might say to myself, well, this is a pretty long-term time frame, and I'm probably better off going with the overall trend. Certainly, it's a filter, but I don't use multiple time frame confirmation. Should we consider a longer-term trend or the psychology of the longer-term trend? Sure, absolutely. But I don't necessarily let it affect my trades on a short-term time frame like this. The larger the time frame gets, probably the more impactful that daily overall psychology gets. But the shorter the time frame is, I'd say the less important it is. Okay? And certainly you can use it as a filter, for sure. I do have some traders that say, okay, if the daily is in an uptrend, I will look for buys across my intraday time frames, which is fine. Again, it's just another psychological filter, which has a lot of merit, and it really depends upon how you want to filter your trades. So thank you for that question, boys. All right, my friends, we'll wrap it up here for today. Thank you so much for joining me. I appreciate your time and your questions, and I'll see you tomorrow morning, 9 a.m. Eastern, for our trade entry talk, and we'll talk more about market cycles and chart patterns and psychology of numbers and all that good stuff. So take care.